Finance Core, Topic 1, the Corporation, Financial Statement Analysis, and Introduction to Excel. Readings for this area include Corporate Finance 5th or 6th edition, Chapter 1, Introduction to Corporate Finance, Chapter 2, Financial Statements and Cash Flow, Chapter 3, Financial Statement Analysis and Financial Models. The learning objectives are 4. We're going to compare corporations with other business forms, understand the construction and analysis of balance sheet, income statement, and statement of cash flow, compute and interpret accounting ratios of solvency, asset management, and profitability, and use Excel to compute financial ratios, compute financials and ratios. So let's start with this learning objective number 1, comparing corporations with other business forms. So let's talk about the corporation. What is a corporation? Well, a corporation are legal enterprises distinct from its owners, in other words, the shareholders, and acts much like a natural person by borrowing money, buying assets, making contracts, being sued, and paying taxes, just like individuals. However, unlike persons, corporations can live forever. Corporations are sometimes called public companies or public firms because ownership shares are available to purchase on exchanges by the public. This allows the corporation to raise large amounts of capital, but also with that, you have loss of control as more shareholders gain voting rights. The corporation is double taxed. It's taxed at the corporate level, corporate income tax, now 21%. However, when shareholders get dividends or capital gains from the sale of the stock, they're also taxed again. So there is double taxation. Shareholders have limited liability. In other words, if I own a stock in a public company, I can only lose my investment. They can't go after, say, my house. Corporations have 3 distinct interests. You have the shareholders, those are the owners of the company. They elect the board of directors, vote on certain issues, and receive dividends if they're paid. You have the board of directors. They represent the shareholders, enact policies, and hire and oversee the top managers. And then you have the top managers who set strategy and oversee lower managers. So this gives you an idea of maybe a typical organization and focus on the financial organization. You have the shareholders represented by the board of directors, who then hires a chairman, who then has a COO, and then under that would be a CFO, the chief financial officer. That organization may look like this. It might have the treasurer and the controller. The treasurers can focus on cash management, credit management, capital expenditures, in other words, large multi-year purchases or purchases of multi-year assets, financial planning. Then you have the controller, where their focus more is on accounting, and that would be tax management, financial accounting, which deals with the external financial statements, cost accounting, which deals with the internal financial statements to help you run the business, and then your information systems. So that might look like a typical corporate finance organization. Now, the focus for this course in corporate finance, we're going to focus primarily on the decision to make capital expenditures and financial planning. And we'll also be talking about financial statements a little bit. So we'll talk about, what information is available both publicly and internally to make decisions. Let's talk about the corporate principal agent problem. So in a corporation, you have the principal, those are the shareholders, and the agent, those are the managers, and they often have conflicts of interest. So shareholders primarily benefit from higher stock prices. So the goal of every manager should be to maximize stock price by maximizing long-term profits and cash flows. So you, as a shareholder, you're the principal in this relationship. The managers of the company are the agent. And so what kind of conflicts of interest can come about? You just want to get, have more wealth, so you want the stock price to go up. So let's think about this. Conflicts exist because there's asymmetric information available to shareholders than managers. And if there's different information available to shareholders and managers, and there's high monitoring cost, in other words, as a shareholder, it's difficult for me to see what managers are actually doing and what information they have, issues can arise, such as they pay themselves excessive compensation or benefits, pensions, jets, condos. There might be short-term orientation by the manager. Maybe the manager only is going to be at this organization for a couple of years, so their goal is really to kind of do things to make the financials look good in the short run. There might be too little risk taking by managers who are not diversified as shareholders. As a shareholder, I can buy an S&P 500 fund for $50 and I own 500 companies. However, a manager, most of their wealth is tied up in their future earnings of that organization. So maybe they just don't take as much risk as they should because they're not diversified as the shareholder is. And also, you might have fraudulent reporting. They might make the financials look better, so they get higher bonuses and the stock price goes up, at least in the short run. So what is some of the mitigation for these principal agent problems within a corporation? Well, you have executive reputation. A CEO or CFO wants to go on to bigger and better jobs, so their reputation is a limiting factor in this principal agent problem. You have stock grants and stock options, so that the managers of the firm also get rich with a higher stock price. You have independent auditors to verify financials. You could have a proxy fight where shareholder votes to replace the board and all its officers if you feel like they're not behaving. You could have takeover by another firm. So ultimately, if it's the company is doing too poorly and the managers are doing a terrible job, it could just be taken over by another investor group. And also you have government regulation, like the Sarbanes-Oxley. It tries to get managers to do the right thing. Let's talk about some other business forms. So many businesses evolve from a sole proprietorship, then to a partnership, then to a corporation. So let's talk about these other business forms. So let's think about a small business. You open up a small business and you're a sole proprietor. So the business is owned by one person with no legal distinction between the business and the individual. In other words, the individual borrows the money, the individual signs the contracts. So there's no new legal form. It's the cheapest organization to establish because of that. And the business pays no taxes. So there's no double taxation. All taxes just flow through the income or the tax forms of the individual that owns it. There's unlimited liability. So these pluses are good things about sole proprietorships. So here are some of the disadvantages. There's unlimited liability of debts and obligations. So I have a small business and it's a sole proprietorship and something happens and they can sue me and go after, say, my house. Also, the business lifetime may be limited by the life of the owners. Also, there's a limited ability to raise capital. Say if I have a small business and I want to really increase the scale of the business. As a sole proprietorship, you don't have the ability to, say, issue stock on public exchanges to raise millions or billions of dollars. Also, as the owner, what if the company's doing really well, but you want to kind of sell off a little of it? Well, it's hard to sell off a little bit of a sole proprietorship versus if you're a corporation, you can just sell off some of your shares. So many organizations, they'll evolve into a partnership. So you can have in a partnership, it's kind of a hybrid between a corporation and a sole proprietorship. So you can have general partners within this partnership. So general partners agreements will specify what roles and percentages, and you can have unlimited liability for certain partners. And so these are your general partners, and you can also have these limited partners that are not involved in daily management. They have limited liability and sometimes called silent partners. So what you have is you kind of have these some individuals that are actually running the business, but then you have these silent partners that are also just serving as investors. And then you have the corporation. You have the limited liability. Remember, the shareholders can only lose the value of the stock if it goes bankrupt or is be sued. You have infinite life. Corporations can live forever. You have the ability to raise large amounts of capital. The shares or the stocks provide liquidity for their owners. Also, those stock options. Once you have stock, you can give managers stock options, which kind of eliminate that principal agent problem, or at least mitigate it. However, downside, you have that double taxation. You do have the principal agent problem, and you have loss of control. What if you started the business as a sole proprietor, you added some partners, you evolved into a partnership, and now you're a corporation, but it's still your company, you feel. However, at some point, shareholders have gotten, or you've added a lot of shareholders, and now they get to vote on certain things, like your ability to, say, acquire another firm or something like that, or pay a large dividend. Also, you may be taken over. If it's a public company, it might be a leveraged buyout or a hostile takeover. They can take over the firm from you. So let's talk about the corporation and society. Let's talk about some criticisms. So criticisms of the corporate structure. One is profit maximization causes externalities such as pollution, and those costs are not borne by the corporation or the shareholder. So these are in economics, we call these externalities. So costs are not borne by the actual principal. Also, this limited liability shields owners of catastrophic risks to society, such as environmental destruction. Exorbitant compensation of top managers and the exploitation of workers contributes to income inequality. Corporations can lead to monopoly, which leads to higher prices and lower supplier choices. Corporations have undue influence on political process and regulation through donations, lobbying, job offers, and extra legal transfers, in other words, bribes. These supranational corporations are able to evade national regulations and taxes. Also, these big corporations are squeezing out small businesses. And lastly, there's no direct accountability to shareholders because of that principal agent problem or to the nation's citizens. So these are some of the criticisms of the corporate form. Let's talk about their defense. Well, these corporations serve the function of channeling individual savings into productive uses. Maybe I don't have any great ideas, but I can invest in Tesla, I can invest in Apple, and I can and share in that profitability. Corporations promote efficiencies due to the economies of scale. So the idea that these large organizations can reduce the unit costs and make, say, iPhones so cheap to me relative to small organizations. Also, it just raises the consumption of everyone. The idea of these efficient, cheap products. Corporations are the engine of innovation. Think originally the turn of the 1900s is Ford and other corporations like IBM, Apple, Google, and then today's, say, Facebook, Uber, Tesla. These are organizations that are innovative and they satisfy consumer needs. Corporations, another defense is corporations are just people. They're no better or worse. One quote is, "You're more likely to be ripped off by your plumber or your car mechanic than Starbucks." These organizations or a defense for executive compensation is to run one of these organizations is almost like a head of state. They have so much responsibilities, not just to be profitable, increasing revenue and decreasing costs. They're also dealing with global organizations, issuing issues ranging from local, state, and federal government relations to demands for social reform. So these managers, the executive compensation is exorbitant, very high, but maybe it's justified with what they're asked to do. These large entities are often at the forefront of social change. So in an age in which legislation is difficult because of deadlock, corporations are able to offer things like same-sex partner benefits that maybe the government wasn't able, or it wasn't, or again, able to, say, pass legislation, and also, say, affirmative action. So some of the largest corporations in the United States, anyway, are on the forefront of social change. And the question is, what are the alternatives? Instead of a corporation providing automobiles or cell phones, would it be better for some other organization like the government to do that? So the question is, does the DMV or post office serve consumers effectively, and do you want them providing other goods for you? But we can talk later, is that really a fair comparison? That for the DMV or the post office, these organizations that have to provide these basic services to every citizen. So this was Corporate Finance Topic 1, and what we did is we talked about the corporation and compared it with some other business forms. In the next topic, we'll talk about financial statements.